You're now listening to the Tax Smart REI podcast. Hey everyone, thanks for listening to this episode of the Tax Smart REI podcast. In this episode, we're going to talk about retirement accounts and some other accounts you'll need to know about, contributions, year-end deadlines, as well as the philosophy of retirement accounts and should you even be using these in the first place. So we're going to go ahead and get started with the philosophy, then we'll dive into those contribution limits and those deadlines that you'll need to know around year-end. So let's go ahead and dive right in.
Yeah, the philosophy piece is really important because I think a lot of real estate investors like control. Maybe it's ego. I don't know. But I'm part of this group too. We like control over our investments and over our money. So the theory is that I can buy a rental property and I have full control over the performance of that rental property, which can be a good thing. It can also not be a good thing, right? It can be a bad thing if you're not a very good operator, or if you buy way above what you should have paid. If you overpay for a property, that can be a problem too. If you're not very good at negotiating with tenants, that could be a problem too. So having full control can be great, can also be bad. Now, I also want to say, before I start asking you questions, because I know you have slightly different philosophy, this is just where, being in this business for a while, this is what I have sseen. Everybody wants control. So they start pulling their money out of equities, out of the stock market, to invest in real estate because they think that they have more control. And a lot of people do well, especially over the past 8 years. A lot of people have done well. But the question's going to be, over the next 2 years, is having all that control good or is it bad? Can you make it through a potential recession if the market's not pushing up rents and pushing up prices on a consistent basis? How well are you executing at that point? Because when the market's screaming, everybody can do well, but when there's it's the difference between a peacetime general and a wartime general. I use that every once in a while at the firm. I tell my leaders, it's great that you're the nice guy and it's so easy to lead in peacetime, but when it's wartime, how are you going to lead your team? And the same sort of principles apply. You need to be prepared to be a wartime landlord. Maybe that's a bad way to put it, but the economy is rocky right now. So this control piece, we might start seeing instances where it was better to leave money in the market, in equities, rather than pulling it out and running your own real estate portfolio. So it'll be kind of interesting to see how it plays out. But people want control. Now, I know that you have a little bit of a different philosophy. You think that you should be well diversified. So talk a little bit about that.
Yeah. So, I like control too, don't get me wrong. But like you were saying, over the last 10 years, the market carried a lot of people, and now it's going to be determined, are you a good operator? And there's a number, just because of these human error that you can make, right? In your business, you can easily make a decision or a series of decisions anywhere throughout your investing career, right? That can wipe you out or significantly damage, your wealth, right? Significantly reduce your wealth. So I kind of believe in having a certain amount of money, a certain portion of allocation to stocks, specifically indexes, broad indexes, because if you use the dollar cost average strategy, you hold for the long term, the market has historically, depending on which time horizon you look at, depending on what reports you look at, all that stuff, basically earned the S&P 500 anywhere between 8 to 11% annually, right? And that's if you just dollar cost averages in, did nothing, and that's all you did, right? And the thing is, when you're investing in a broad index like the S&P 500, you have, publicly traded companies with top management, right? Managing these companies, you don't have to think about it. And yeah, there's going to be bad actors in that portfolio of 500 every once in a while that might go to zero, but over the aggregate, again, that's going to earn you anywhere between 8 and 11% per year moving forward for just doing nothing. So all you have to do is nothing. So I look at it as an insurance policy. I look at stocks and index funds as an insurance policy, because I know that put the money in there, and at the worst case, I'm going to get somewhere between 8 and 11% return annually. And sure, can you make more money in real estate? Yeah, in an up market, if it's just bull and you're just not up to do anything, right? It's just charging forward. But if you're not a good operator, or you take your eye off the ball, you could again lose everything. So I look at that, say 20% of my portfolio as an insurance policy against any bad decisions that I can make. Then the rest of my portfolio, I'm either going to be investing actively in, where I'm the operator, or I'm investing passively with other operators. But again, all of those things carry risk, right? A lot more risk than just investing in the market. So that's my philosophy on it.
If you're listening to this and you're like, oh, I keep my eye on the ball, we're going to run a real quick test. If you are the person that looks at your bank account or looks at a property management statement that just kind of shows rents, but you don't have good bookkeeping financials on a monthly basis, right? So you're not actually doing any sort of accounting, or you don't have a team that's doing the accounting for you. And I don't mean just the property level accounting. I mean, we're factoring in our mortgage, our insurance, our property taxes, anything above the property level, right? So if you're just looking at your bank account once a month or once every couple months, you're going to have to tighten that up.
Yeah.
Because in a down market, that's taking your eye off the ball. If you want to run really tight operations, you need those transactions booked throughout the month in an accounting platform, ideally like QuickBooks Online or something similar. And you want financial reports at the end, and you want to start tracking trends, because then that enables you to have better conversations with your property managers and come up with strategy on an ongoing basis, or pivot if you need to. And I'm guilty of this. Last year, 2021, that's all I did. Well, really, even before that too, I would just look at my bank account and I would know, hey, my bank account's going up. Cool. I'm making money. If it's going down, maybe I'll start digging into it. And that is fine in an up market, right? Because my properties are appreciating. It's going to cash flow relatively well. So no big deal. But in a market that goes sideways or down, you really got to tighten that up. And that's what I've been doing with my own portfolio, is really starting to do the accounting on a monthly basis and get real financial reports and start tracking trends, so that I can start having better communications with my property managers, with the contractors. I can start thinking about what sort of repairs and what sort of CapEx I want to put into the property, and when I want to put that in the property based on the trends that I'm seeing. So that's like the litmus test. If you're just kind of passively checking your bank account and going, oh, wow, man, I invest in real estate, this is so much fun, you're the one that's going to be hurting in a sideways market or a down market. So start now, get ahead of it now. And I know I'm talking about accounting, and I know that we offer accounting, and it might seem self-serving, but it's really important. It's really important to track every single penny. And if you're not tracking every single penny, then you are going to lose if the economy turns south. So if you're not going to track every single penny, then you should definitely be looking to diversify. Right. Absolutely be looking to diversify, because what it means is you're just not, you either don't have time or you don't have the desire to operate, right? And the people that don't have time or desire to operate are the people that will get burned when the market turns south.
Right.
If you don't know how to structure a team, if you don't know how to utilize capital efficiently, you will get burned when the market turns south. And that is the downside of having control.
Right.
Nobody else is there to hold you accountable to streamline and efficient and effective operations.
No, 100%. And also, I just kind of want to contrast that too. Even if you're investing as an LP, right? Like, even if you're investing as a limited partner and you're picking sponsors, right? There's still a tremendous amount. Sometimes it's about risk, right? It's about operations. So if you're going to be running the show, you need to have the time and, the desire, like Brandon said, to actually run your portfolio like a business, to make sure it's operating efficiently, all of that. And there's risk in that, and there's human error in your own capability of doing that, right? So it's more risky to do that than it is to put the money in the S&P 500, to be quite honest with you, and just do nothing. So you need to be able to be a good operator if you're going to go that route. If you're going to go the LP route, then you're picking sponsors and you're picking opportunities and hoping they perform well. And these aren't publicly traded companies. There's not as strict reporting guidelines and all that stuff. They have exemptions to the SEC rules, right? So there's more risk in that. Yeah, there's opportunity for higher return, but you can make an error in your decision making when picking a sponsor. These sponsors can make errors, right? So there's a possibility.
The sponsors can make errors. People think that sponsors can't make errors, but holy smokes, we have seen some wacky sponsors come through at our time here at the firm. I mean, you've got to be really careful picking sponsors. Yeah. You've got to be really careful picking sponsors.
Right.
And I'm sorry to cut you off, but I just this is just so important to me, because the sponsors that have spun up in the last 8 years have not gone through a recession.
Yeah.
So you have to take that into account. Like, you can't just go all in on a sponsor thinking that this is going to be great. Like, if you look back over the last 3 years and they've done so well for you, that's great. But what happens again when it goes sideways or down? I can't tell you how many sponsors we've had come to us that say, my budget for tax and accounting is $2,000. And we're like, what, you mean a month? No, for the year, $2,000 for the year. So these are sponsors that are raising millions of dollars, and they're going to spend $2,000 on tax and accounting for the entire year, and they're getting them from some courses or something. You know, like these courses tell you what to budget for all this stuff. So using some percentage, I don't know how they come up with it, but you know, we just are like, holy smokes, man, you're gonna lose people money because you're not taking this seriously. It's not a serious business for you. So you got to be careful picking those sponsors. You really do, especially now going into a potentially sideways or down market.
Yeah, not going to go too much into a rabbit hole and picking sponsors, but right now I'm evaluating a lot of sponsors, and you know, to Brandon's point, it's really hard to tell over the last 10 years. So what I'm looking at is the sponsors that have been around for 20, 30 years, right? You know, how have they performed throughout the years? And I'm also looking at sponsors who maybe got into the game over the last 10 years, but have a long track record of investing themselves prior to getting to the game that they can leverage. So they might have seen it, maybe not on the syndication side, but they've seen it in their own investing experience. So you really got to be careful. You got to look at that track record, because there's so many sponsors that got spat out of all of these like coaching groups, and they all look the same. They sound the same. You hop on a phone call with a sponsor and they basically tell you the same thing, to the point where it's like, I don't know if I'm talking to this guy or that person, doesn't matter. They all saying the same thing. So really be careful. But the point in all this is there's risk in not only your selection of the sponsor, but there's risk in the sponsor not executing.
And I mean, you've got the problem with the last 5 years or so, maybe a little bit more, is twofold, right? One, it seems like everybody's making money in real estate. So everybody wants to pour money into real estate. So there's tons of capital available. But two, you've got social media, right? So you're seeing like Grant Cardone and all these people posting on Instagram and being on all these podcasts and just talking about how amazingly successful they are. But sometimes they're not. Sometimes they're either not successful, or sometimes they're like that one guy this month or last month that was indicted for fraud. He was a sponsor, like bank fraud, I think. It was wire fraud. Matt.
Yeah, I don't know who he's. I've heard of it, but I mean, this isn't the first.
Yeah,
time.
well, and but the thing is like he did the Bigger Pockets circuit, and nothing against Bigger Pockets. You can't. I know I saw like a lot of people were saying, oh, Bigger Pockets should do better vetting of podcast guests, but like the reality is, and I mean, we can speak to it too.
Yeah.
When you have somebody on, you look through, you try to make sure that it passes the smell test, right? You don't want to like obviously bring on a blatant fraud, but you don't really know. Like, it's not like we're saying, oh, well, open up your books and let's check your internal controls. Yeah, you can't do that to get people on a podcast. But I think like the other thing too is that whenever they are on a podcast, it doesn't necessarily mean that they're engaging in fraud at that time. So that makes it really difficult. So point is, don't blame Bigger Pockets. It's not their fault. But yeah, that guy was on the Bigger Pockets podcast, has this big Instagram following, like just social media guy, right? And I just think that you got to be careful, you know, investing with influencers. You just got to be careful. Not to say that they're wrong or bad. You just got to be careful. And like the people that spun up sponsors, like the GPs that started over the last 5 years, again, they're not wrong and they're not bad necessarily. You just got to be careful, right? So Tom just said he's looking for sponsors that have been around for 20, 30 years. It doesn't mean that if a GP started last month that they shouldn't be investing, you shouldn't be investing with them. It just means you got to do more due diligence. Right.
And you got to have a higher risk tolerance if you're going to invest in them, because the reality is they're taking their first or second swing at this, and it's just a higher risk tolerance, right? And there's just more risk involved. So that's, again, the entire reason why I'm saying my philosophies have some of it towards the market, because I view the S&P 500. Yes, there's volatility. I look at volatility as a measurement of risk, right? But I don't look at volatility as a measurement of risk, really. I look at it, it's just market. It just happens. The reality is the S&P 500 is not going to zero. If it goes to zero and you lose all your money, then there's going to be a world worst.
It's over. Yeah. The world is gone. We have not survived. If the S&P is at zero, we're toast.
So whenever I do my calculations,
we're marching, and we're like, I don't know, we're
not doing this podcast anymore. We're going to be over fighting some war, right? And that's the reality of the situation. So I look at the S&P 500 in my own philosophy, and I'm not saying everybody's philosophy, but in mine, as the risk-free rate of return, right? That's my risk-free. That's the hurdle rate that all these other investments have to overcome.
Sorry, I've got a question for you real quick. So if we kind of get back to the S&P versus real estate and everything, how would you advise somebody that has 90% of their net worth in real estate? 90%. What would you tell them to do? Say the other 10% in cash.
So I would say
let's just say for just to further this, that they started investing after 2008, 2009. All right, so they haven't been through a major crash. And let's also assume that they're a mediocre operator. So they're not amazing,
Yeah.
They don't have everything dialed in, but they're not just treating it as just, they're paying attention. They're just not dialed in, if that makes sense.
Yeah. I mean, that's a good question. I mean, long story short, I would advise that you start allocating some capital, to like broad index funds, right? Like the S&P 500 or the total stock market. How to actually get there, that's a whole nother story, right? Like how you're going to get the funds, right? Because you have 10% in cash, and maybe you need that 10% in cash to, make sure you have the working capital for your portfolio, right? Then you have 90% locked in an illiquid asset such as real estate. So how can you tap into that? You could either tap into that through cash out refinances or HELOCs, or you could sell, right? And
would you do a cash out refinance though? Because that's going to add debt to your real estate position.
Yeah, I don't know that I would do that. I would probably look to sell maybe a part of the portfolio, maybe, and that's going to depend on your market and, can you get the price you're looking to get right now? I know it's tough out there. Inventory sitting out there longer. People are putting in lowball offers, waiting for prices to come down, waiting for basically sellers to capitulate and say, okay, this isn't the 2020, 2021 market where everything's running up. So the sell side might be tough right now. So, it would depend on everybody, on the individual circumstance, but I'd be looking at, say, hey, can you sell a portion of your portfolio, hopefully in a tax efficient manner, to move some of that capital you have tied up in real estate into the stock market? And right now is not actually a bad time, probably. I'm not saying it's the best time, but probably not a bad time to start building a position, because the market is still down. I think last I checked, like 15-20% year to date. And, people argue that the market's still overvalued, and maybe it is, maybe it isn't. But the reality is it's still down 20% or 15-20% from where it was at the top. So now it's not the worst time to allocate capital to the stock market and start building that portfolio. So that's what I'd recommend. I would say, okay, you have 90% in real estate. How can we get maybe somewhere between 10 to 20% of that into stocks, right? That would be the question.
So you're gonna want to see somebody get 10 to 20% of their total net worth into stocks over what time horizon?
It's going to be dependent on how much and how quickly they can liquidate their portfolio.
Because that's the other thing I was thinking too, is like you could theoretically use the cash flow from the rentals and then also your job, if you have a job or business, to build a position as well. You don't necessarily have to liquidate your portfolio.
Yeah, you're right. You could dollar cost. If you have the liquid cash flow, if you have the discretionary income, or you have the income that you can allocate there, either, like you said, from your job or from your cash flow. I assume most real estate investors don't cash flow, because that seems to be the trend of almost everybody I talk to. It's like, yeah, appreciation is great, but can't cash flow. So anyway, but assuming you are cash flowing, sure, you could put the money from the cash flow into the market, just not an IRA or a 401k, because it's not earned income, right? The cash flow from rental real estate. However, if you have a job or you run another business where you're actively involved, then at that point you can generally contribute to a retirement account you want to, or you can just build a brokerage account. But that's a good.
And what if this person tells you, well, I want cash because the market is kind of sliding. It's off of its highs, and I think there's going to be some opportunities that come up over the coming months that I want cash to take advantage of. Do you still tell that person, hey, look, I understand that, but you really need to be getting some diversification here? And if you do, why? Why is it important to get that diversification?
Yeah, so I would say this. It comes down to, this is a big question to ask. If I was actually going to help someone with this and want to let everybody know, I would comb through a lot of your data, ask you a ton of questions before I made any recommendations. All right. But for the sake of this conversation, I would say, like, how much is your discretionary income, right? Whatever that number is. Just say it's $2,000 a month. I'm just pulling a number out of a hat. I'd say, well, why don't we take a portion of that and commit to dollar cost averaging that into the market, starting to build this position? Because again, the market is off the high. It could still go lower, but this is why we're dollar cost averaging in, because the entire dollar cost average in strategy is, as the market goes lower, you're reducing your cost basis, your overall cost basis in the asset. So in the S&P 500 index fund, for example,
because you're buying more,
because you're buying more, because you can
right. So if you buy one share at 100 and one share at 50, then your two shares average cost basis is $75.
Right.
So you've essentially like taken that $90 cost basis and dropped it 20, or that $100 cost basis dropped to $25.
Right. So that's the purpose. And like, long story short, you could run like charts on this and graphs for days. And basically the long story short is, when you do it over time, you come out ahead because of the dollar cost averaging strategy. The market rises over decades, and you should always be dollar cost averaging. It is the bottom line. I do that. So a portion of my money gets dollar cost averaged in, rain, shine. I don't care if the market's soaring or not soaring, it's going in, because it's you're disciplined. You're using that strategy. I say commit to that. Then put the rest of your money Right now, interest rates in savings accounts or CDs are all right. Some people are recommending putting them in short-term treasuries that are like running 4%. So you buy a 3-month treasury and hold it to maturity, theoretically, and that's kind of a way you can earn a little bit more on your cash while it's sitting there. So that's probably what I'd recommend. Hold a portion in cash, build your cash portion of it, and then but continue to dollar cost average a portion of that discretionary income I mentioned before into the market, and that's the commitment in perpetuity, effectively.
Love it. Well, thank you very much for helping us think through that. Tom is a CFP, which is a certified financial planner. And I don't know, do you have to put any disclosures up? Like he's a financial planner, but not your financial planner.
I'm a financial planner. This is general information and for informational purposes only. It's not financial advice. We're talking in broad generalities here. If you want, go speak to your own financial planner to get the most appropriate advice for your specific situation, because there's a lot of factors to consider in a financial situation besides just your income or your allocation. There's a lot more stuff that goes into it, and there's no possible way that we can go through everything here on this podcast today. So before you make any major financial decisions or shifts in your investment strategy, go run it by your own financial advisor and make sure it makes sense for you. Now that we got the philosophy, why do I have one more thing into the philosophy? One more thing. A lot of people ask, well, should I invest in a self-directed IRA or a self-directed retirement account? This happens all the time. We get this question. And my personal philosophy on it is, it depends. So it depends on basically two things. So what is your current allocation of capital right now? If you have all of your money or the majority of your investable assets in retirement accounts and it's all in the stock market, and you're like, oh my God, I don't want it all in the stock market. I would rather see most people self-direct a retirement account and get exposure to a syndication or whatever they want to invest in through a self-directed retirement account rather than have them liquidate their retirement accounts and be exposed to income taxes and penalties. I've seen people try to liquidate their account where they'd be paying 40 to 50% of the account balance just to get the money out. You know how much your returns you'd have to earn to get that back? A lot. I don't know the exact answer, but a lot. So I'd rather see people self-direct if the majority of their assets are in retirement accounts and they want that diversification out of stocks, right? However, if you don't have all your money in investable assets in IRAs, I would prefer to see people have stocks and index funds, etc., in their IRAs, in their retirement accounts, because it's tax sheltered, right? It's very hard to shelter capital gains from the sale of stocks and dividends from tax outside of a retirement account, right? But it's easy to shelter rental income and gains in the sale of rental property outside of retirement accounts. So I'd prefer to see people invest cash outside of retirement accounts in real estate, where they can get it tax sheltered, and stocks in their retirement accounts where they can get it sheltered. So that's kind of my philosophy there. A lot of people always ask that. So there you have it. But now we're going to kind of move into some of the more boring stuff in a sense, but it's fun. Everybody needs to know this stuff if you're going to be considering making contributions to retirement accounts. So let's just start with the Roth IRA, right? So kind of give everybody a brief rundown on what a Roth IRA is. Roth IRA is an account that you make post-tax contributions to. Post-tax meaning you've already paid tax on it, and meaning it's not deductible. You're not getting a deduction for making this contribution. So you make the contribution to the Roth account. It will grow tax-free within the Roth account. So you put $10,000 in, you invest it in whatever, it grows $15,000. Well, guess what? That $5,000 grows tax-free. You're not paying tax on it. Now, when you pull the money out in retirement, 59 and a half is the current age, it's also tax-free when you pull it out. So you don't have to pay tax on it when it comes out. Now, there's also something called an RMD, required minimum distribution. So most retirement accounts, when you get to a certain age, things like 72 and a half, you have to start pulling out the money. They force you to do it. Otherwise, there's heavy tax penalties if you don't. So Roth IRAs are not subject to RMDs. So you don't have to pull the money out in retirement if you don't want to. So a lot of tax advantages of doing that. So Roth IRA, if you can make contributions, whether it be directly to the account or through a backdoor Roth, really a no-brainer, in my opinion. And the deadlines to make a contribution, the good news is you have it up until April 18th if you're an individual. Only individuals can make the account, so I guess that's it. April 18th, 2023 to make the contribution to a Roth IRA or a traditional IRA, and the account can be opened after year end. Last thing on Roth IRAs, if you're looking to make contributions to these accounts, you can make up to a $6,000 contribution if you're under the age of 50, or a $7,000 contribution if you're 50 or older. Now, there are some income limits. If you're looking to make a contribution directly to a Roth IRA account without having to do a backdoor, and I'll touch on a backdoor in a second, you're going to have to earn under $129,000 if you're single or head of household. And there is a phase out from $129,000 to $144,000 per year where you can make a partial contribution to the Roth, but not the full $6,000. Additionally, if you're married filing jointly, you're going to have to earn under $204,000 to make that contribution. And there's a phase out between $204,000 to $214,000 if you're looking to make that Roth account. Now, if you're above these income limits and you're unable to make a Roth contribution directly to the Roth account, the good news is there's something called a backdoor Roth IRA. Backdoor Roth IRA allows you to make contributions to a traditional IRA, generally post-tax, so you'll be above those limits as well, and then roll it over into a Roth IRA. It is still possible for you to make those Roth IRA contributions. Now, there are some things you do want to be aware of. If you are considering a Roth, something you'll want to speak to your financial planners and tax advisors about before making a Roth contribution, if you already have a traditional IRA that has a balance. And that is the IRA aggregation rule under section 408D2. And basically what that says is that if you have IRA accounts, or you have multiple IRA accounts, and you don't roll over the entire balance all at once, basically what happens is you're going to have a proration between the pre-tax dollars that were contributed to your traditional IRA and the post-tax dollars that were contributed. And so to kind of give an example, if you had an IRA account with $100,000 in it and you made a $5,500 backdoor Roth IRA contribution, only about roughly 5% of that rollover would be considered after tax, and the remainder would be considered pre-tax if held in the IRA. So just a little complicated, not going to flesh it all out here today on the podcast. Just know that if you have an existing traditional IRA where you're making pre-tax contributions, so at some point you're making pre-tax contributions that were tax deductible to your traditional IRA, and now you're looking to roll it over to a Roth IRA, there might be some additional tax planning measures you need to take to make sure you're maximizing or the efficiency of that rollover. So just something to keep in mind. Now we're kind of just going to move on to traditional IRAs. So traditional IRA, basically what a traditional IRA is, allows you to contribute the same amount as a Roth, so $6,000 if you're under age 50, up to $7,000 if you're 50 or older. So the contributions to a traditional IRA are traditionally made pre-tax, meaning they're tax deductible, but they are subject to some income limits, right? So you can make these pre-tax or these deductible contributions when you're married, when you're single and your income is $68,000 or less, and you are covered by a workplace plan, meaning you have a 401k or another retirement account at work. It's going to be $109,000 if you're married filing jointly. And there's phase-ins here. So if you're single, you can make a partial pre-tax contribution between $68,000 and $78,000 in income. If you're married, it's $109,000 to $129,000. Basically, again, what this means is you can't make that full $6,000 contribution pre-tax. You can make a partial contribution if within those limits. And again, that's for people who are also covered by a workplace plan. If you're not covered by a workplace plan, meaning your business or your job does not offer you contributions, basically what ends up happening, it does not offer you like a 401k or another type of retirement account, then there are no income limits, meaning you can always make the contribution to your traditional account pre-tax. The income limits on the pre-tax income limits only apply when your workplace has a retirement plan. All right. So next we're going to cover 401ks. There's a lot of other types of retirement accounts that you can get through an employer, 457s, there's 403bs. There's other ones. There's a lot of other ones, but we're only going to cover the 401k today. So 401k is traditionally provided by an employer, or maybe you have a self-directed if you're self-employed, but they allow you to contribute up to $20,500 if you're under the age 50, and an additional $6,500 if you're over the age 50, for a total of $27,000 again, if you're over the age 50. Now, contributions can be made pre or post-tax, so either to like a traditional or Roth account, Roth 401k. And unlike IRAs, there are no income limits for 401k contributions. There are no income limits to the Roth side either. So that's a good thing about 401ks. Now, Your employer can also make contributions to the traditional 401k account and not the Roth. So combined, you can make a combined contribution between the employee side and the employer side of $61,000 and $67,500 if you're over the age of 50. So there's something to know about 401ks. Now, the good news is for traditional IRAs and Roth IRAs, the contribution deadline is going to be April 18th, 2023. So the deadline for filing individuals, not the extension deadline, but the original deadline, April 18th, 2023 for Roth and traditional IRA contributions. With 401ks, it's a little bit different. 401ks, you have to make the employee side of the contribution before 12/31/2022, right? So all these numbers, by the way, are 2022 numbers. They are going to change for 2023. So in 2022, if you want to make an employee contribution to your 401k, you have to make sure that you let your employer know you want to make that contribution before the end of the year. Otherwise, you're not going to be able to take it. As for the employer contribution, that can be contributed on your behalf up until the extension deadline. So your employer has up until, depending on what type of business, how their business is structured, up to September 15th or October 15th to make that contribution on your behalf. All right, so that's about it for today's episode. If you did enjoy what you heard, do have any questions, feel free to join our Tax Smart Investors Facebook group. There's a ton of conversations taking place in there right now. You can visit Facebook and just search for Tax Smart Investors. You'll be able to find us like that, or you can visit www.facebook.com/group/Tax Smart Investors and join that way. That's all for today, and we'll catch you on the next episode of Tax Smart REI.